Recently, I read a paper that has sparked heated debate on Wall Street. Its title is Beyond the Status Quo, a critical assessment of lifecycle investment advice. Why is it so controversial? Because it almost overturns the common investment wisdom we've all been taught. Traditional financial advice tells us not to put all our eggs in one basket. When you're young, you should hold more stocks, and as you get older, gradually shift to bonds to reduce risk. But this paper draws a shocking conclusion. The optimal portfolio across the entire life cycle should be made up by 100% stocks. And not just domestic stocks, but with a heavy allocation to international stocks. According to the author's model, over decades of investing, the optimal allocation is 33% domestic stocks and 67% international stocks, a 100% stock portfolio. So, how did they reach this conclusion? The paper uses an innovative backtesting method called block bootstrap. Traditional studies often rely on assumptions like normal distribution to project future outcomes, but this paper does not. Instead, it directly uses real historical data to simulate the future. Specifically, it uses stock and bond data from 1890 to 2025 across 39 countries, dividing the data into 10-year blocks and sampling randomly. The advantage of this approach is that it not only preserves historical sequence correlation, but also more realistically reflects the long-term volatility and crises investors might encounter. Compared with traditional methods, the results are more robust and closer to what ordinary investors are likely to face. To measure the differences between portfolios, the paper introduces an interesting metric called the utility equivalent savings rate. It means that if you take a 10% savings rate with an all-stock portfolio as the baseline, how much would other portfolios need to save to achieve the same retirement utility? The results are very clear. For example, under the same returns, a traditional 60-40 portfolio would need about 19.44% savings, and a target date fund would need 16.27%, just to match the performance of an all-stock portfolio. Not only that, the authors also compared retirement failure rates, meaning the probability that you are still alive, but your money has run out. Using the classic 4% withdrawal rule, the 60-40 portfolio has a failure rate of around 16.9%. TDF is 19.7%, while the optimal strategy is only 6.7%. This means that if you follow traditional advice and hold more bonds, you're actually more likely to run out of money in retirement. The authors also looked at maximum drawdown, terminal wealth, and bequest value, and in almost every measure, the all-stock portfolio outperformed both 60-40 and TDF. Now, at this point, you might be thinking, if this strategy performs so well, does that mean it is the one true answer? Not necessarily. The paper itself has some limitations. First, the asset classes it studied are quite limited, only including domestic stocks, international stocks, government bonds, and short-term treasuries. It does not include other possible options like gold, commodities, or real estate. So the results are really a comparison of stock-bond portfolios, not every possible asset allocation. Second, although the method is innovative, using block bootstrap to splice together real historical data into possible futures, it still relies on history. If the future market undergoes structural changes, like interest rates staying at extreme levels for a long time, or new asset classes emerging, past data may not be enough to predict the future. Still, despite these limits, the paper forces investors to rethink traditional investment ideas and gives us some important insights. The first insight is to redefine what risk really means. According to traditional theory, the risk of holding stocks is volatility, so stable bond prices are naturally considered low risk. But this paper suggests a different view. For long-term investors with horizons of several decades, the real risk is not short-term volatility, but failing to achieve financial goals and having purchasing power eroded by inflation. From this perspective, stocks may swing more in the short term, but over the long run, they far outperform other assets. The paper shows that international stocks have a long-term real return of about 7.03%, almost fully offsetting inflation, with correlation to inflation at only minus 0.01. In contrast, government bonds return only 0.95% in real terms, with a strong negative correlation to inflation of minus 0.78. This means bonds face severe erosion in inflationary periods. So the volatility of stocks is essentially the price investors must pay to capture long-term high returns, not an unacceptable risk. On the other hand, bonds may seem stable in the short run, but their low returns pose a huge long-term risk, significantly increasing the chance of investment failure. From this angle, bonds over decades are actually the true high-risk asset. The second insight is to take a long-term view when assessing asset characteristics. Traditional thinking often relies on short-term static perspectives. For example, in one-year periods, stocks and bonds have near-zero correlation. So many assume they're the perfect long-term diversifiers. But the data in this paper shows that when you extend the horizon to decades, the relationship changes fundamentally. Domestic stocks and bonds may have near-zero correlation in the short term, but over 30 years the correlation rises to 0.45. This means bonds cannot truly hedge stock risk over the long run, and their diversification benefit is much weaker. So when you look at investment in decades-long horizons, bonds are no longer the safe defensive asset. Instead, stocks are the more reliable core over the long term. The third insight is that once we accept that stocks should be the core, we need to balance global diversification and home bias. Traditionally, many investors' portfolios show heavy home bias, with too much concentration in domestic markets. But the paper reminds us that over the span of decades, no single country leads forever. History shows that every market rises and falls. The most reasonable approach is to diversify globally, building a market cap-weighted portfolio that includes different countries. This effectively reduces unsystematic risk from any single market and lowers the uncertainty of betting on one country. The paper's optimal solution is clear: about 33% in domestic stocks and 67% in international stocks, forming a global all-stock portfolio. This is not only a balanced choice in a globalized view, but also the most resilient allocation for a decades-long horizon. The final and most important insight is to distinguish between theoretical optimal and practical feasible. Mathematically, the optimal strategy from the model is almost 100% stocks. On paper, this delivers the highest long-term return. But remember, the model assumes rational investors who never panic, never get greedy, and never lose control in a downturn. In reality, most people are not like that. According to the backtest, while the all-stock portfolio gives the best long-term return, it can also suffer a maximum drawdown of 55% in the short term. Imagine your wealth shrinking by more than half in a single year. If that keeps you up at night, or worse, makes you sell at the bottom, then this optimal strategy could actually be the worst for you. The real lesson of the paper is to understand your risk tolerance and emotional resilience. If you can't handle such a big drawdown, then adding some bonds, even if it lowers your long-term return, can serve as a psychological buffer to help you stick with your plan through the toughest markets. At the end of the day, the most important thing is not to find a mathematically perfect strategy, but to find one you can actually stick to. As Warren Buffett says, the key to investing is to survive and stay at the table. All right, that's it for today's video. I'll put the link to the full paper in the description below, so if you're interested, you can read it in detail. If you found this video helpful, please give it a like and subscribe to the channel. Your support is my biggest motivation to keep creating. I'll see you in the next one.